What's going on, you guys? So we are back here looking at my top 5 stock picks for 2018, doing our monthly review for this stock portfolio. So this has been a very volatile time for a couple of these stocks in particular. We're going to talk about Chesapeake. Today alone, looking at this stock, they are up 18.25% after being down quite a bit over the last 3 months. So Chesapeake has been dragging this portfolio down significantly, but we saw a good earnings report come out from Chesapeake, so we're going to cover that. And all 5 of these companies have reported earnings, so we have a lot to talk about in this video. But first of all, let's go ahead and look at the actual performance of this portfolio and see how we're doing so far. So if you guys are not familiar, these were the picks that I made back in December of 2017 as my top 5 picks for 2018. And every single month around this time, I do an update video talking about the performance of this portfolio, just for a good learning example. Now, when I made these picks, I didn't want to make just boring picks and pick obvious winners. I wanted to make it more interesting, and I really am glad that I did that, and I'm glad I included a very speculative investment like Chesapeake, just so I could use this as a learning example as to what happens when you make speculations. They can be very volatile, and the stock can go down quite a bit if things are not looking good for that investment. And things were not looking good for Chesapeake at all. They had announced some layoffs in January. We're going to talk about that. And as a result, that stock has absolutely tanked. So overall, this portfolio is up 4.96% as of right now, and we're looking at it during the trading day, so it's going to fluctuate. As far as the actual stocks go, we have a couple of big winners and a couple of big losers here. So Applied Materials stock is up 9.1% since they've been added to this portfolio. Amazon stock is up 27% since they've been added. Chesapeake is down 19%. They are really dragging down the performance of the stock portfolio. GE is down 14.3%, and Boeing is up over 20%. So obviously Boeing and Amazon have been the big winners of the stock portfolio here. Applied Materials is third place there, still having a very great return of around 9.1% there. And then we're seeing that GE and Chesapeake have been significantly dragging down this portfolio. Now, before I get into this full video, I have a quick message to share from the sponsor of this video, a man by the name of Ryan Scribner. He has a quick message to share with you guys. How's it going today, guys? Welcome to Stock Radar. I am so excited about this. I've been planning on doing this for months now, and I am officially launching Stock Radar. We're going to be doing weekly stock analysis as well as bonus stock market related videos that will only be available through this membership, and I'm just so excited. I'm glad to have you guys here. And we're going to start off by talking about the company known as Coca-Cola, one of the best stocks to invest in, period, and a great pick for beginners. As a member, you will get access to a private Facebook community for Stock Radar where you can have discussions with others about investments. You will also get a weekly in-depth analysis of a particular stock. You also get the ability to vote on what stock I analyze next over in the private Facebook group. And you also will get bonus lectures that will not be available anywhere else. We will be analyzing 5 different characteristics of each investment. First, the history and the age of the company. Is this a brand new company with no track record or a time-tested company with a great reputation? The second characteristic we'll be analyzing is the dividend. Does this company pay a dividend? And if so, how long have they been paying this dividend and increasing the dividend as well? Third is the moat and barriers to entry. This is all about what isolates this company from the competition. The question answered in this section is what stops me from starting my own version of this company. Fourth, the pros and cons. What makes this a good investment and what should investors be concerned about? And finally, the fundamentals. We will be looking at key financial documents to determine the overall financial health of this company. Learning about a company takes hours of research, and I am here to streamline that process for you. Welcome to Stock Radar. Alright, so like I said in that brief video there, guys, my stock membership site, Stock Radar, is officially open, and for the first week only it is going to be $14 a month to join, and then that price is going to $19 a month forever. And down the road that price is likely going to increase, but if you guys think you're interested in joining Stock Radar, where we're going to do weekly stock analysis, you'll have a private discussion group to talk with others about investments, you'll also have the ability to vote on what companies I analyze each week. If you guys are interested in checking that out, the link for that is in the description below. But now we're going to go ahead and go into more detail about this particular portfolio and talk about these stocks here. So one of the first things I want to talk about is how I would have actually set up this portfolio if I was invested in all of these stocks. It would not be an even 20% split like I have here. I just wanted to do it like that because it would be better for us to keep track of this. And this example here is if you had $10,000 invested in each one of these stocks. Now, if I was actually investing in these stocks, and I do have a very small position in Chesapeake and GE. A lot of people are asking me, like, am I losing my shirt with Chesapeake Energy? I have less than $1,000 invested in Chesapeake, and I have about $4,000 invested in GE. This is a very, very small portion of my portfolio. So while I am down on those two investments, it is not dragging down the performance of my portfolio all that much, and I still have confidence in these stocks in the long run. As we know, GE just paid a dividend, I think it was about a month ago, and I was able to scoop up more shares of that stock with that dividend, so I'm going to be reinvesting those dividends over time, getting more shares of GE, and letting that investment ride for a couple of years. So I have no concerns with being a GE or a Chesapeake shareholder. They're not a large part of my portfolio. They're a very small position in those two investments. So that being said, if I actually was going to invest any amount of money into these 5 stocks, it would not be an even 20% split into each stock. This is what I would do. So if I was investing money into these 5 stocks, first of all, I would follow the cardinal rule by Benjamin Graham, which is to speculate with no more than 5% of your total portfolio. Now, because Chesapeake is a speculative investment, I would put 5% of my portfolio into Chesapeake Energy. Now, GE is a recovery stock. They're a stock that is performing very poorly right now, and as a result, I would put 15% of my money into GE. I would put 20% into Applied Materials, 20% into Boeing, and then I am a bit biased towards Amazon. I absolutely love Amazon stock, so I would put 30% of my money into Amazon. So if I actually redid this portfolio and set it up with these numbers, we would not be seeing as much of a loss, but I'm going to leave it the way it is, just because it's a better learning experience for everyone if we look at if you had invested an even amount of money into each one of these stocks. But if I was actually going to go out there and build this portfolio myself and invest money into it, I would not be investing my money in an even split. It would look exactly like this. But again, it's up to you guys to make your own decisions as to what you are going to do as far as diversification across different stocks. And again, remember, this is really here just for educational purposes. I am not a financial advisor. I am not telling you guys to buy or sell these stocks. I just wanted to share this with you guys as an interesting monthly series and see how these picks perform throughout the year of 2018. But first of all, let's take a look at Chesapeake stock here, okay? So like we said, we added them around December 25th when they were around $3.85 a share, and they really were doing pretty well throughout the beginning of the year. They went up to a high of $4.28, but then around January, they announced some bad news. They announced some layoffs, and the stock just went into a free fall. It fell to a low of $2.63 a share. Now, today, they posted earnings. We're going to go over those earnings, and they were up 17.68% today. They're now at about $3.11 per share. So first of all, let's talk about the bad side of Chesapeake Energy. Around January 31st, they announced that they are laying off 13% of the workforce, or about 400 employees. So I'm going to go ahead and read the letter that the CEO, Doug Lawler, shared with investors and also the employees. He said, "Dear colleagues, by now you are aware we have undergone a reduction in Chesapeake's workforce this morning. The action impacted approximately 13% of our employees across all functions of the company, primarily on our Oklahoma campus. The decision to reduce headcount did not come easily from the leadership team. Dedicated, value-driven, hard-working people have been affected. You will have my personal assurance that we are treating these employees fairly, respectfully, and with considerable effort as to assist them with their personal and career transition. Over the last couple years, we have divested approximately 25% of our wells, primarily from non-core areas, as a key part of our strategy to reduce debt, enhance margins, and work within our cash flows. While those divestitures resulted in headcount reductions in the field, transition services agreements with buyers of certain assets caused us to not make corresponding staffing changes in Oklahoma City. As those transition arrangements have now come to an end, and we will continue to see increased efficiencies across the company, we needed to respond accordingly. Chesapeake has proven its resilience and strength, and we must continue to structure and position the company for greater success. As you have heard me say repeatedly, transforming a company requires discipline, tough decisions, great talent, and a shared vision and culture. I will be hosting a town hall in the coming weeks to discuss our progress and share my confidence in what we are accomplishing working together as one Chesapeake. Thank you for your commitment and dedication to our company, Doug Lawler." So essentially what he is saying here is they sold off about 25% of the assets or the wells that were not in core areas, and they are focusing on the core areas of the business that are likely to turn a profit, and as a result, they're not going to need as many employees, and so they were laying off about, like they said, 13% of the workforce. Now, is this a bad move for Chesapeake? I don't think so at all, because they do need to scale back and focus on the profitable side of the business, and as a result, it makes sense for them to sell off the non-profitable wells that they are operating. Now, nobody likes to see when a company is laying off employees. They see this as a shrinking down or a shriveling down of the company. But I think that tough moves really had to be made with Chesapeake, as this was a company that was just not doing well at all, and there really were concerns with this company going bankrupt. So they really had to focus on cutting down on costs and hopefully in the future increasing their margins. So I think this is a positive for Chesapeake, but as we said, it resulted in a significant dip in the share price. And maybe if you were paying attention to this stock, you caught that dip, and you might be having a pretty good day today. So now let's go ahead and talk about the earnings report that came out this morning for Chesapeake Energy. Obviously, it was a very positive one here because the shares are up over 15% this morning. So there were three main components to this earnings beat here. First of all, Chesapeake had higher oil and gas production. Second of all, we saw better gas and oil prices. And third of all, it is a result of the cost-cutting efforts, some of those we just discussed with the layoffs of those employees at Chesapeake Energy. And as a result, Chesapeake Energy reported quarterly profits and revenues that exceeded Wall Street analyst expectations. That is why we saw a pop in the share price. Now again, just keep in mind this is still a very speculative investment, as Chesapeake Energy is still down over 50% over the last year. However, they are showing signs of improvement as of this quarterly earnings report. So earnings per share came in significantly higher than Wall Street analyst expectations. And then looking at the revenue, we see that revenue came in at $2.5 billion compared to a forecast of just $2.3 billion. So they also beat revenue expectations as well. So primarily this was driven by better commodity prices. We see here that U.S. crude prices rallied 17% in the fourth quarter of 2017, and that significantly helped out Chesapeake as far as beating revenue expectations for that quarter. So Chesapeake said they expect their total output to rise 3% in 2018, with oil production growing at 5% for the year. And the company also said they can produce more oil and gas while spending about 12% less on capital expenditures due to the fact that they are leaning out the business and focusing on the core areas that are working for them. So we are seeing increased production with decreased expenditures. That is exactly what Chesapeake Energy needs right now. So as far as their debt reduction goes, in 2017, they reduced their debt by 32% or $1.3 billion. Now, the company is still burdened with debt, but it is a very good sign to see them reducing that debt significantly in 2017. So that is definitely a plus for Chesapeake Energy. Again, the majority of that debt reduction was a result of them selling off assets that were just not profitable for them. And now, again, by announcing those employee layoffs, that is going to help them cut costs as well. But that wraps up this section talking about Chesapeake Energy. Now let's go ahead and move on and talk about Applied Materials. And again, if you guys are interested in reading any of these articles, I'm going to have all of these linked up in the description below, so feel free to check those out. But we're seeing here from Applied Materials that shares rose, this was earlier in February, as a result of a dividend increase and an earnings beat, so let's go ahead and talk about that more. So the first big piece of information here for Applied Materials is the fact that they have doubled their quarterly dividend payment to 20 cents per share. That is a big plus for shareholders. Second of all, we saw that revenue rose to $4.2 billion from $3.28 billion in the year prior. And on top of that, earnings expectations were $1.03 per share on revenue of $4.11 billion. And they came in at $1.05 earnings per share on revenue of $4.22 billion. So Applied Materials beat analyst expectations for revenue and earnings per share and also doubled their dividend. And as a result, we saw a significant bump in that share price. So as we said, Boeing is one of the top performers on this list so far, and we saw that Boeing reported earnings per share of $4.80, which was almost double what they had earned from the previous year on revenues of $25.37 billion. Now, much of this was the result of the recent corporate tax cuts, which many U.S. airlines have also benefited from. So airline stocks in particular are seeing a boost from this corporate tax cut. So that is, again, that's a plus for Boeing stock and shareholders who are invested in companies, large companies that are going to benefit from the new corporate tax structure. Now, a big plus again for Boeing is that they said that they expect to deliver between 810 and 815 commercial planes in 2018, which is up roughly 6% from the number they delivered in 2017. And again, remember that Boeing operates on a backlog. Anytime they are building one of these commercial planes, it is not because they are looking to build it and then put it for sale. They build one after it has been purchased. So they are never sitting on inventory. That is one of my favorite parts about investing in Boeing, is the fact that they're not sitting on inventory. They know exactly how many planes to make, and seeing an increase in that backlog and an increase in the production of 6% is a big plus, and that should help the stock rally more into 2018. So Boeing announced a strong earnings report and increased their guidance for 2018, and also said they are going to be increasing production capacities from what they had in 2017. So that is a big plus for Boeing, and as a result, we saw an increase in the share price. So now moving on, we're going to talk about General Electric, the second worst performer in this portfolio. And as we see here, it says General Electric falls short in fourth quarter earnings, but offers stronger 2018 outlook, which is to be expected from General Electric. This is a recovery stock, as we have said before. Now, another issue for GE stock is they had announced that they are being investigated by the Securities and Exchange Commission over its accounting practices, so that's not looking very good for GE. GE's fourth quarter fell short of Wall Street expectations, but offered up a stronger than expected outlook for 2018. So what we are seeing here is that GE reported a loss from continuing operations of $10.01 billion or $1.15 per share from earnings of $3.48 billion or 39 cents per share. And GE reported earnings per share of 27 cents per share, which was 2 cents below analyst expectations. Now, as far as revenue goes, revenue fell 5% to $31.4 billion from about $33 billion a year ago, and this was far less than analysts had expected, with one analyst having estimates at $34.06 billion. Now, it says here that a portion of the charges taken in the fourth quarter are at the center of the SEC's investigation. General Electric's review led it to take a $6.2 billion after-tax charge. The company also plans to contribute $15 billion to the unit over the next 7 years to shore up its portfolio. So a couple of notes here from the CEO, Flannery. He says that our results this quarter demonstrate some of the early progress we are seeing from our key initiatives. The team is focused on operational execution, capital allocation, and deep cost reduction to position us for continued improvement in 2018. So we may be seeing some of the early signs of that so far, but still we see a lot of bad news for GE stock in the short term. Now, GE also said it removed $1.7 billion in structural costs in 2017, above the $1 billion it was targeted for this year, and the company says it aims to remove another $2 billion in costs in 2018. Now, as far as the 2018 outlook goes, GE says they are expecting adjusted earnings per share to range between $1 to $1.07 for 2018. And then finally, we have to move on and talk about Amazon, the top performer of this portfolio, and Amazon had a fantastic earnings report. So Amazon beat analyst expectations on strong holiday sales and significant growth in its cloud business, or Amazon Web Services. So as far as the numbers go, revenue came in at $60.5 billion versus $59.83 billion expected. Earnings per share was $3.75, and Amazon Web Services revenue came in at $5.11 billion versus $4.9 billion expected. Now, looking at the revenue here, these numbers are absolutely incredible, but Amazon's revenue jumped 38% year over year, and they report their revenue in three segments. It's North America, International, and then Amazon Web Services. It said that North America revenue jumped 42% to $37 billion, while international sales grew 29% to $18 billion. Now, Amazon Web Services continues to be the big growth driver for Amazon, and they saw a 45% increase in sales year over year. So anyways, guys, that wraps up my update here on the top 5 stocks for 2018. Make sure you guys let me know in the comment section below what you think about these picks, what you think about these earnings reports. I would love to hear what you guys think. And again, if you are interested in joining Stock Radar, my new weekly stock analysis membership group, remember for the first week, the membership is going to be just $14 a month. And as always, that first month is fully refundable if you guys watch the videos included in that and you decide it just isn't for you. All you have to do is shoot me an email and I will get you a full refund. But the details for that are in the description below, and there will also be a pinned comment. But I thank you guys for taking the time to watch this video, and I will see you in the next one. If you are interested in learning more about investing in the stock market, I've created a free course just for you. The link is in the description below. Here are a few other videos you might enjoy as well.